Well, the numbers were weak. The expectations were weak. The numbers were weaker than what the weak expectations were. And this has been the case for HUL for the last few quarters, more than, 3 or 4 quarters. In fact, Morgan Stanley has written, and they say that their earnings for HUL have been below estimates for the 4th quarter in a row. Weaker top-line growth due to lower volume growth. Negative pricing growth remains a headwind. They've cut their target price from 2,500 odd rupees. Remember, the stock has not done much in the last 12 months anyway. The target prices have been cut further now to 2,464 odd rupees as well. They have an equal weight rating on the stock. HSBC has downgraded the stock to reduce. The target's cut from 2,700 to 2,350. They say the outlook appears uncertain and growth itself is lackluster. Importantly, the terminology FMCG for HUL and all the others, ICICI has decided to perhaps question that itself. They're calling it SMCG. Now, it's not fast-moving consumer goods, it's slow-moving consumer goods. So let's see how that pans out. In fact, I spoke to the management yesterday post, the results itself, and spoke about when is it that they expect any sort of recovery in the volume growth, and also, importantly, the outlook on margins. The company spoke about 2 things in particular that they're watching out for. One is income growth in rural India, and secondly, the yields of the winter crop. Those 2 factors will give them a reasonable sense of what is expected in the rural economy. Listen in.
Our focus remains on driving gross margin. First, we got our gross margin improved, and we brought it to the levels of pre-high inflation. The second job that we have, so remember pre-inflation, we had roughly 52% margin, gross margin, which we brought back. And our job now is to go back to pre-COVID levels, where we had 54% gross margin. And hence, driving gross margin will continue to be a tremendously important focus for us. But equally, as Rohit mentioned, dialing up investments, not only in advertising, sales promotion, but also in product superiority, also in capability, remains squarely important, and leaning in as required on price and promotion, the way we have done in this quarter. When you saw in this quarter, our sequential margins for beauty and personal care and home care declined a little bit compared to the previous quarter, because we leaned in with product investments, we leaned in with price and promotion to ensure fuller volume recovery. So there are those puts and takes always in the P&L, and where our margins are today at 23.7, they are healthy margin. And we have maintained that the levels of margin that we have today, we are happy with this margin. Our single-minded focus is to ensure fuller volume recovery and keep dialing up growth.
Your assessment would lead to, growth in volumes once again from a macro standpoint. By when do you see recovery in rural?
Yeah, so there are 2 factors we called out which will really determine the pace of recovery. Number 1 is the rural income growth, and we know that that's an area which is important for us to see those markers. And second is the winter yield. In our view, those 2 elements should determine the pace of recovery as far as rural is concerned. And as you mentioned, that overall there are categories like F&R, which today we have lower single-digit volume decline because of commodity inflation. Now, the good news again is where we are today, we are seeing commodity inflation in food categories also moderating, which means now, like the balance 3 quarters of the business, even this part of the business then should start seeing year-on-year price inflation getting moderated, and then should help further recovery of volumes in that portion of the business as well. So those, I would say, are the 2 large elements which would determine sequential further recovery of volume from where we are today.
And just to follow up on that, the points that are within our control are invest in market development, sales, which have got the future spaces where we see consumer upgrading. We see high growth there already at about roughly 2 or 2.5 times our average. Premiumization, we see again, those segments are growing very, very fast. Innovations both in value and feature. So the job we as market developers and market makers is essentially to lean in on those vectors. And we see high level of productivity of doing that. And all of the investments and moves that you're seeing from us are essentially to put more focus around market development, premiumization, and innovation.
Okay, well, that's the management of HUL. We need to take a short break. But on the other side, we will have the FMCG analyst of Sher Khan joining in to discuss more on the Q3 performance of the company. Stay tuned.